Hey guys, SGT here. I'm just thrilled to have on the line Daivd Schectman, the founder of Miles Franklin Precious Metals. David, welcome.
Well, it's nice to be with you, Sean. It's my pleasure.
You, sir, do a tremendous amount of research, and you know all the top people. You know the Jim Sinclairs, you know the James Turks, you know the John Embrys. You've been at speaking engagements with these people, and we just really appreciate your perspective.
I'll be happy to share it with you. And you know, I really did do a lot of speaking, but that was mostly in the 80s and early 90s, and that was around the world. And then I decided enough of the travel. I've got a business to run and a newsletter to write. But I'm well connected in the industry, and I've spent 27 years trying to figure out what this is all about.
Well, and you've helped those of us who are newer to it, so we really appreciate that. What do you make of the down day we're seeing today? We're seeing gold get hammered. We're seeing silver get absolutely annihilated here on Thursday the 10th.
It's just a small correction. It's just less than 2%. I mean, take a look at a 6-month, a year, a 5-year chart on gold and silver, and it's full of ups and downs and zigzags. That's what Sinclair calls noise. It means absolutely nothing. What you're seeing, people aren't buying and selling their physicals. These are hedge funds popping in and out, taking a short-term profit. The people who buy gold and silver, who are selling their contracts, have no particular interest in gold or silver. It's just a thing that they trade, and they make a profit, or their algorithms tell them it's time to buy or to sell, and they pick each other's pockets. But in the end of the day, it means nothing. And in my daily today, by the way, which was written last night, I said, looking at what happened yesterday, the price of the metals were pretty flat, but the stocks were down a fair amount. And it made no sense. And you can bank on the fact, whenever that happens, the stocks will lead the metals down the next day. And I said Thursday should be a very interesting down day for gold and silver. So, you know, they telegraph it. It's almost as if the bullion banks who are manipulating the precious metals, they like to they don't make it not only in the stocks, but they make it in the metals, and the one signals the other of what's coming in the next day. And sure enough, the market opened today at it coming in from London in a huge down. Take a look at it in a week or two. You won't even notice that today happened.
Yeah, and I try to remind people, buy in regular intervals, regardless of what the price is doing. Just acquire silver, acquire gold over time.
Well, the name of the game is ounces. It's not price. Mm-hmm. At the end, how many ounces do you have? It doesn't make any difference what you paid for it. You got to have a lot of ounces, and I've been buying steadily since 2001. I started buying seriously when gold was under 300 and silver was under 450. And I'm buying now, last week, this week. I just don't want dollars, so the price to me is irrelevant. If you cost average and put the same amount of dollars in, and per purchase, then you don't overpay or underpay. You really average out your pricing. That's what most people ought to do if they're not certain.
Yeah, and one of the game changers now, too, is that not only is the Fed printing money hand over fist, central banks are now buyers of gold.
Well, that was inevitable. Just as they were in the late 70s, the seller became the buyer, and this was necessary for the bull market to move into stage 3. If you look at a graph of gold for the last 10 years, it's a line from the left side of the chart to the right side of the chart that moves up pretty linear 45 degrees. When it's going up 90 degrees, straight up. Now we're in the fun part of the market, and I think we'll see that within the next 24 months.
I wanted to talk to you, sir, a little bit about the silver investment. I think it's really popular right now for people to say, well, keep in mind, gold and silver aren't going up in price. What we're seeing is the dollar fall. And I actually take exception to that, and I want to talk to you about it because I view silver as a tremendous investment. And I view it that way because, number one, we've seen silver almost double over the past year, and we haven't seen the dollar fall by 50%. So that's number one. And number two, there is so much paper manipulation in the market, as was discovered at the March 2010 CFTC hearings, in which Jeff Christian admitted to 100-to-1 paper manipulation of gold and silver.
And people will say, well, and you've heard it today, there's not that much physical metal out there. There isn't. But in the physical market, as the market uses that term, there is much more metal than that. There's 100 times what there is.
My position is that silver is an excellent investment because there's 100 ounces of paper out there for every 1 ounce of physical. What's your take on that?
First of all, I look at silver in two ways, and I don't think you can separate them. Silver is not only an investment, and we'll talk about why and how outstanding an opportunity current pricing really is, but it's also the ultimate insurance policy, and you can't separate the two. I go back to late 1970s when, with silver rising over 35 on the way towards 50 an ounce, there were many gas stations right in my location where I lived where I could bring a silver dime and trade it for a gallon of gas. Silver is the ultimate insurance policy during a currency crisis, which is something that certainly is a possibility going forward. And a bag of junk silver is 10,000 dimes. Each of them, I would imagine, in that environment has the buying power of today's $10 bill. So you buy silver in that form as an insurance policy, and then we can discuss silver also as an investment. Historically, the ratio between gold and silver has been roughly 15 or 16 to 1, and this goes back many, many centuries. When this country was founded, the relationship was exactly 16 to 1 gold to silver, and that relationship held true actually even in 1980. So it's not unusual. What's unusual is what has happened since, where the ratio got as high as nearly 100 to 1. A year ago was 65 to 1. And it's currently 39 to 1, and I suggest on the way down to 16 to 1 again. So one of the things that makes silver a good investment is it is underpriced historically, probably by 3 times. Whatever I expect gold to do, I expect silver to do the same times 2.5 or 3 going forward. So using that as a metric, if I believe, and I do, that gold will hit at least 3,000 an ounce. If we divide it by 16, that's 187.50 an ounce for silver, which we can buy for the low 30s right now. Now, if that doesn't make a good investment, I'm not sure exactly what does.
No, and I agree with you, and I think the historical standards are absolutely noteworthy, for sure. I mean, in fact, John Embry is predicting 2,000 gold in the near term with a 30 to 1 ratio. That puts silver at $67, and he's expecting it, like you do, to go back to its historical norm of about 15 to 1. But now if we talk briefly about the paper fraud in the market, at what point do we actually even extrapolate further that silver is not only a great investment, getting back to the 15 to 1, but a almost inconceivably great investment as this paper fraud unravels?
Well, let's talk about where the tire meets the road when you talk about a paper fraud, a real example of it. When we had shortages in silver in the fall of 2008, the COMEX price of silver was pulled from, I think, 22 down to around 10, maybe a little bit under. In other words, paper contracts on silver said silver was worth $9, $10, $11, $12 an ounce, but if you called us or any reliable dealer in the country and tried to buy physical silver for delivery, you would have paid $22 to $24 an ounce for that silver. So which is the real price, the paper price or what it costs to actually take delivery of the metal? There can be a huge disconnect there, and the minute that actual shortages hit the market, all you have to do is go on eBay and take a look at what a silver eagle is selling for and compare it to the spot price of silver, and you are in for a rude awakening. Now, the next time we have one of these shortages, and I would suspect we'll see it this year, maybe fall would be my guess, watch what happens to the price when you are able to get it compared to the paper price, which is an absolute fraud. And when you leverage something 100 to 1, you can manipulate the price for a while, but it only works, the manipulation, as long as you're able to source enough physical metal to deliver to the contract holders. And from what I find out in talking to people I know in the industry, people like HSBC and especially J.P. Morgan are paying the people who are long silver to keep them from demanding physical delivery. They're paying them premiums of 50 to 80% more than the actual price of silver, not to take the silver.
This concludes Part 1. Click here for Part 2.